Good evening, and welcome to the Nightly Market Brief for Wednesday, June 17th. Tonight, we're reviewing the primary fundamentals that moved each sector today as we head into Thursday. The defining event across the indices was the hawkish statement delivered by newly appointed Federal Reserve Chairman Kevin Warsh. The deletion of traditional forward guidance and the elimination of all upcoming rate cut language caught equity desks slightly off guard. Stock indices sold off as an emerging committee majority signaled potential future interest rate hikes. The metals corridor was directly impacted by the upward momentum in the U.S. dollar. Precious metals saw liquidation as safe haven cash migrated away from non-yielding assets, dragging gold and silver down on the day. Industrial metals like copper also weakened as traders paused long positions to digest higher borrowing cost projections. Energy contracts experienced minor technical adjustments, but remained largely insulated from the Fed news. The overarching driver remains the aftermath of the preliminary U.S.-Iran memorandum to reopen the Strait of Hormuz. Because the risk of a supply outage is now priced out, crude oil and gasoline are trading on normalized global physical flows. In the currency markets, the hawkish policy statement pushed the dollar higher. The dollar advanced against all major global currencies, fueled by the elimination of the central bank's easing bias and lingering concerns over elevated energy inflation forecasts. Crypto futures reversed their recent gains as global liquidity conditions tightened in response to the Fed statement. Higher for longer, borrowing cost expectations prompted short-term capital outflows, pulling Bitcoin and Ether lower as speculative interest rate hedges were dialed back across the derivative desks. Interest rates recorded a major across-the-board repricing following the revised dot plot projections. Fixed-income futures traders aggressively sold off short-term paper and shorted bond contracts, driving Treasury yields higher as the market-implied odds for a year-end interest rate hike moved up significantly to adjust to a highly restrictive monetary regime. Finally, the agricultural complex moved independently of the financials, posting solid gains. Grain pits were driven entirely by localized supply disruptions, with wheat pushing higher on fresh global crop concerns. Soft commodities split, with cotton finding support on export demand, while coffee adjusted to harvest delays in Brazil. Today's action shows exactly why you have to follow market momentum, long or short. I'm going to hand it over to Alex, and I'll see you tomorrow.
Thanks, Michelle. Today's statement from Chair Kevin Warsh highlights why we maintain a systematic, trend-following approach, rather than predicting policy shifts. The Federal Reserve kept the federal funds rate unchanged at 3.5% to 3.75%, but altered the baseline format. By condensing the text to 132 words and deleting traditional forward guidance, the committee removed its previous easing bias. Furthermore, the revised dot plot shows 9 out of 18 officials now project a potential rate increase by the end of 26, while the year-end inflation forecast was raised to 3.6%. This shows that the central bank expects energy-driven price pressures to linger, despite recent diplomatic progress in the Middle East. These sudden policy adjustments are standard market aberrations. To manage this risk, a desk must be positioned to execute both long and short positions under a strict mechanical framework. For our long-term positions, we use premium neutral collars to define risk. We sell an option contract at our upside profit objective and use that collected premium to buy the put option that limits our downside. This overlay is premium neutral, balancing the time premium collected with the premium spent. This structure eliminates the risk of being stopped out on erratic price swings and reduces your margin requirement to the exchange maintenance margin, or the maximum risk on the trade, whichever is less. This improves capital efficiency without incurring net option premium decay. Our team manages the daily technical operations, utilizing Chart VPS and CQG integrated client to route execution through premier exchange members worldwide. When an account is held directly at an exchange clearing member, your funds are fully segregated and protected under exchange rules, plus or minus your regular trading activity. This infrastructure provides total price transparency, the ability to utilize United States Treasuries to satisfy margin requirements, and liquidity back to your account within 2 to 48 hours in any major currency. Our core trend qualification rules are laid out directly below this video player on the EMA analysis page. Contact us if you have questions or would like to review our top automated trading programs. Please note, due to regulatory jurisdictions and minimum financial requirements, we may not be able to accommodate your account. If we are unable, we can refer you to a fully licensed broker in your regulatory jurisdiction who can. Good trading, and we'll see you right back here after tomorrow's settlement.